Invest, invest, invest. Taxation, taxation, taxation. The mantra and the reality. Just what will the Labour government's first budget yield in the medium term? Because in the short term, it's received poor press. I'm going to be putting these questions to Victor Hill. He is a financial economist, consultant, trainer and writer with extensive experience in commercial and investment banking and fund management. I'm delighted that he joins us now to share his thoughts about the budget and the wider economy. So invest, 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 Victor.
Well,
what does it all mean?
Good morning, Sarah, and thank you for your very kind and generous introduction. It's very good to be with you again. So let's put it in its historical context. First of all, if you go back to 1945, this is probably only second in terms of the amount by which taxation has been increased. So we've got an uplift in tax revenues forecast in the order of £40 billion. That's, well over 1% of the economy. 1993, back after the ERM crisis, Lamont, the Chancellor, as he was then under the Major government, put up taxes by even more than that in terms of percentage of GDP. But if you go back to the 90s, oh my goodness, they were a kind of a halcyon age when the GDP, the debt to GDP ratio was about 34%, and the economy was actually ticking over quite well, and growth rates of 2.5% or more were being recorded. Well, the situation these days is much gloomier. We have a debt to GDP ratio of over 100% and growing. The demographics are very poor. The OBR recently released a long-range forecast which envisaged that on current trends, the debt to GDP ratio would reach something like 270% of GDP by the year 2070. Well, we won't be around probably by then, but the direction of travel is clear. The economy is not growing. We just managed to avoid a recession. We've come out of this period of steep inflation, but I'm afraid the headwinds are exceptional. Now, Reeves, as I say, has put up, in her wisdom, the tax take to something nearing 39% of GDP, and that is exceptional. So invest indeed. Private or public investment, this is something we need to talk about.
Indeed, Victor, that is what we're going to discuss. But just before we get into the minutiae of what she discussed, on the popular press and the highbrow press, there's been a lot of talk about the reaction of the gilt markets to the budget and that interest rates won't be reduced as quickly as had been hoped by those with mortgages, at least. Did the gilt markets behave in a way that you thought they would after you digested the budget?
Well, as you say, the litmus test of how the money men perceive the effectiveness of the budget and the medium range prognosis of where we're going to be in 5 years' time, because the OBR projections go out until the end of this parliament. The litmus test is how the gilt markets and the wider financial markets respond. Now, it's interesting that when Reeves was speaking and in the immediate aftermath of the budget speech on Wednesday, the markets tended to, were perceived to have reacted positively to the package, despite the, the whopping increase in employer national insurance contributions, which we will discuss. Since then, now that they have been able to digest the small print and to look into detail at the spending projections and the borrowing projections going out over the course of this parliament over the next 5 years until 2029, they have become much more sceptical that this budget is going to boost growth and will resolve Britain's economic woes, which we can go drill down into in more detail in the course of our discussion. As I just looked before we came on air, and the yield on the 10-year gilt was around 4.46. It's down very slightly. It hit over 4.5 at close yesterday. You're going to see, some variation in that level. But overall, the trend in recent months and in the 2 days since the budget was announced is upwards. That means that government borrowing costs are going to increase over time. And do remember, Sarah, that one of the biggest items in the budget these days is the cost of that debt, namely in terms of the interest service bill that the government must pay to bondholders, to gilt holders, every year to compensate them for carrying those bonds. And that bill is due to exceed £100 billion over every year of the current Parliament. So to put that into context, it's very likely that, in fact, it is certain that the debt interest bill will exceed the education budget. In terms of the stock market, there was no very substantial reaction, although a moderate decline, but that's within the daily variation anyway. Currencies, well, sterling has recently been relatively strong against the euro and the dollar, as one might expect, because our interest rates were left on hold at 5% last month. The ECB rate is down at 3.25 now, so there's an interest rate differential. And it's interesting to observe that the German government can raise 10-year funding in the current market at less than half than the British government is obliged to pay. So it's 2.2 against 4.4 something. So I think we must conclude that the markets believe that there is yet more detail to come, and that I'm afraid Reeves has not convinced them that she has been able to resolve some of our major issues, of which sluggish growth is the most pressing.
Okay, Victor, you mentioned there the whopper, which is big increases in the employers' national insurance contributions. Has Labour broken its manifesto promises? How does it compare with other tax regimes? Because you mentioned Germany there.
Well, Labour promised, as you will recall, during the election campaign, not to raise taxes on working people, and that meant that they would not take money out of their payroll. So that the bottom line every month, income tax and the employees' national insurance would not change. Now, it's a little bit tricksy to say, well, they promised not to raise employee national insurance contributions, but that they said nothing about employer national insurance contributions. And that's effectively what they've done. Out of the uplift of 40 billion in tax revenues levied on the British economy, next year, about 25 billion pounds worth of that increase will be in the form of increased national insurance contributions paid by employers. And that arises because the rate has increased from 13.8 to 15%, and the threshold above which employers are obliged to pay NICs on the salaries they pay has been reduced from 9,100 to just £5,000, meaning that even very part-time occasional employees become subject to employers' national insurance contributions. So what is I've just done a back of a spreadsheet calculation, and if you employ someone full-time, 37.5 hours a week on the minimum wage, this year, it will cost you £24,130. Given the increase in the minimum wage and the increase in employers' NICs, that will go up to £26,630. So that's an increase of £2,500, just a little bit more, in fact, which is well over 10%. So how do employers respond to this? Well, in the first instance, they're likely to put up prices. So, Sarah, when you go to Greggs for your vegan sausage roll next time, expect it to cost you a good 10% more. They may decide not to pass on the entire uplift, but if you've got 100,000 employees, as they have, that equates to quite a lot of money, millions and millions, and it's coming off the bottom line. It will probably result in lower corporate profits, and that will trickle through in terms of lower corporation tax receipts. So all of these measures have knock-on effects and unforeseen consequences. We're just debating this morning. A lot of the early morning news has been concerned by the effect on, particularly the leisure and hospitality industries, which tend to employ, large numbers of people at relatively low levels of salary. But also, we're talking doctor surgeries, which will be very radically impacted by this measure. And it will have inflationary consequences, as well as incentivizing employers not to raise wages by as much as they might otherwise have done, and not to take on new staff. Now, there is a school of thought that that's not necessarily a bad thing, because in order to improve productivity, we need to automate. And I don't know where you buy your petrol, Sarah, but you might have noticed all the big supermarket petrol station forecourts have automated. It's all pay at pump now, isn't it? There's no little person in a box taking your credit card. So that's an example of automation. Well, you can automate and you can remove jobs, which will have an impact on, obviously, employment levels. But there are certain things you can't automate, or you change the character of the service if you automate. So, if we go into a pub, you wouldn't expect to have a vending machine to dispense your gin and tonic, Sarah, which wouldn't be the same experience.
No, it wouldn't be, but I do get my vegan sausages the same place where I get my petrol. But you talked about incentivization there, Victor. There didn't appear to be any reprieve for landlords and decent landlords at that in the budget.
This is something about which I feel very strongly. I mean, in a free and democratic society, a market economy, why shouldn't you or I invest our hard-earned capital in bricks and mortar and try to generate a return on it? It's a perfectly legitimate thing to try to do, to make provision for one's retirement, and hopefully to build up a nest egg for the future. And it's not just this Labour government, this new Labour government. The last Tory government had a long campaign against landlords, and much affected the tax advantages of buying property to let. And as you say, most landlords are decent and want to provide, sound and pleasant accommodation for people who don't want to buy. Remember, there's a large demographic out there of people who, for whatever reason, either can't or don't want to purchase property, and they would rather have the flexibility of signing up for a one-year rental agreement or whatever it may be. And those people, they're not stupid, and they want value for money just like anybody else. The more you drive landlords out of the buy-to-let market by putting up stamp duty, as has just happened in this package, or by reducing the deductibility of mortgage interest payments, which the Tories did, obviously you're going to get people leaving the rental sector. Landlords will sell out. Property prices may indeed come down as a result of that, but the supply of rental accommodation will diminish, and therefore rents are likely to go up. So I do not see who benefits from these measures.
So you talk about the desire to build up a nest egg, and obviously just asking for a friend, Victor, but state pensions, you and I are of a certain age. What's your view on
Yes.
the pension fed within the budget?
Yes, well, hands up. I got my All England bus pass in July, which I'm very proud of, and I do use it, and it's extremely useful. So yes, I do have a dog in this fight. But in terms of the abolition or the cancellation of the so-called winter fuel payment, I do actually believe, and I know a lot of people won't like this, I believe that was justified for two main reasons. Firstly, it's completely untargeted. Why should Lord Sugar get a check for 200 quid at Christmas, courtesy of Her Majesty's government? The well-off were getting it just as those who were in desperate need. The second reason is that it's all a little bit outdated, because when you think about it, most people, the overwhelming majority of people, pay for their gas and electricity by direct debit, and that is the payments are smoothed out over the year. So there's no particular reason why they need a sudden fillip at Christmas time. There are people who are, still putting coins into meters, and well, my heart goes out to them. But on the matter of pension credit, we are told, or we are reassured, that people who are in receipt of pension credit, that's the top-up payment for people who don't receive the full basic state pension, we're told that they will continue to receive the winter fuel allowance of 200 or 300 pounds if you're over 80. Well, actually, I think that's controversial too, because without going into too much detail, we don't have to, a lot of those people are not receiving the full state pension because they did not pay in the first place, for whatever reason. Perhaps they arrived in this country in their 40s or 50s or even later, and then applied for a pension. They only have they have less than the 30 odd years of NIC employee NIC payments. So you get a situation where some people who haven't paid in over their working lives are actually getting a bonus at Christmas, which those who did pay in and paid every penny that was due will not receive. So I rest my. I think it's that aspect is badly conceived, and I think it should be much more targeted, as I say, towards those people who are reliant on putting coins in meters.
You mentioned Lord Sugar there, which brings me to the budget's effect of abolishing the non-dom status, really. Will the rich leave? And, what does rich actually mean these days? The billionaires?
Well, I guess there are various tiers of wealth, aren't there? I mean, there are the nomadic billionaires who choose to set up shop in Kensington or Chelsea or wherever, with their estates in Surrey or Scotland. But there's a lot of people who are not in that billionaire league, who are able to shop around for different jurisdictions and domiciles, and to decide where to live and where to invest, where to park their capital. And it's not just the billionaires who are going to be leaving. It's also the your common or garden multimillionaires. I think we should just give pause here, though, for a moment, because we are told that the non-DOMS regime, which was basically an envelope whereby wealthy people who reside in the UK didn't have to pay tax on overseas income, that's going to be replaced by some kind of residency regime, which we are told, whether we believe this or not is another question, will be competitive internationally. So I still think we need to find out what the package is that will replace the non-dom regime. I mean, it was a little bit of a concept whose time had been and gone in terms of domicile as opposed to residency, and there are a lot of very strange quirks in those laws. Like I do believe that Sajid Javid, who was Home Secretary, if you will recall, and then Chancellor under the Tory government, was classified as a non-dom because his father had resided in Pakistan. Well, I don't really get that. There are all kinds of wrinkles to these rules. Just in terms of what will be the decider, the clinching factor for the very wealthy is inheritance tax. I mean, if they are going to be subject to 40% inheritance tax on their overseas assets, they will leave, period.
I am possibly personally less worried about the non-DOMs. I am worried. I'm very fortunate. I live in a village, but I'm very worried about what's happening to the farmers and inheritance
Yes,
tax and what the
so
impact
am
will
I.
be on food security.
Yes, this is a terrible blow that has been unleashed on the farming community. And I live about half the time in a village like you do, and I get to speak with local farmers. And I can tell you, they are pretty much all of them, they're asset rich and cash poor. And returns available on farming are very slim. We all know that they've been hammered by the supermarkets. This year, they've endured extremely poor weather conditions with a lot of flooding where I live in East Anglia. They are having an increasingly difficult time. The subsidy regime has changed completely since Brexit, and not entirely to the good. A lot of them are complaining about that. The whole point about farming is that it's a very long-term business. And farmers, will proudly tell you often that the farmer's been in one form or another in the family for generations. And what they try to do is to look forward to the next generation, hopefully, if they're successful, adding to their holdings and bequeathing that to someone who's going to take over and take it forward. And this 20% levy of death duties on all land and other assets amounting to over £1 million is going to be a very serious hammer blow for family-owned farms. It won't affect the large institutional investors who invest in agricultural land through institutions. It's not so much about the tractors and the machinery, because, as you probably know, Sarah, a lot of farmers these days actually don't own that many tractors and machines. They contract out to contractors at harvest time and drilling. What they do is that they husband the land, they look after the land, and they try to allocate it in the most efficient way possible. And that's where we are getting our food supplies from, in large part. And I've written extensively in the past about the whole issue of food security in a much more dangerous world, given the geopolitical risks that we encounter. And the idea that a lot of farmers are just going to give up makes me very sad indeed, and worries me, because it will make us much more dependent on imports of food, often from countries which have much lower standards of animal welfare than we do. So this is not going to go away. We're going to hear more about it. This is going to go on, rumble on and on. And I would not be surprised if our farmers become a little bit more French and blockade the motorways with their tractors.
Okay, understood. Well, I know where I live that that the dairy farmer makes most of his money from the pumpkin season, but because of the weather, he didn't get many pumpkins this year. We are running out of time, so
Yes,
3 quick questions, please,
yes.
because people watching this video will be wondering whether whether the UK is worth investing in. So, will the Starmer government change Britain? What are the chances that that administration will reinvigorate growth?
Well, growth. The OBR doesn't see growth dramatically increasing in terms of the figures released on budget day. So by the end of the decade, we'll still be rumbling along with a growth rate of around 1.2, 1.4%, which is not disastrous, but it's not particularly good when you consider that the USA has been accelerating away from us at 2.73%. And developing countries are rapidly catching us up. At this rate, by the early 2030s, our friends, the Poles, remember Poland in Eastern Europe, which was poverty stricken under communism, will have a higher level of GDP per capita than we enjoy in this country. So looking at it historically, as economists tend to do, between 1945 and 2009, the trend growth rate, which is basically the arithmetic average over those years, the growth rate for the UK economy was 2.7%. Then came the financial crisis, from which we never seemed to recover. Then came COVID, which was another explosion in the national finances, from which we still don't seem to have recovered. And our growth is now pretty paltry at around the 1% mark, which is actually marked up from previous estimates in the last month or so. To turn that around is going to take something more substantial than just than more tax spending and borrowing, which is the formula that Rachel Reeves and her government is advancing.
So I don't really want Trump to have the final word in our conversation, but that might be the case because in the coming week we will get the US presidential elections. Will the outcome affect the UK economy?
At the margin, yes. I'm going to put my neck out and say, I'm not going to predict who is going to win next week, but I do predict that it will be a decisive result and that we will know by Wednesday morning who will be the 47th president of the USA. And if it is Mr. Trump, I'm afraid that we are facing the whole issue of tariffs. And that's not just on Scotch whisky, but it's against manufactured exports as well. He's going to hammer imports of Chinese electric vehicles, as the Europeans already have done. That will initiate a trade war, which will have all kinds of ramifications. In the case of a Kamala Harris victory, well, I think we're just going to see more of the same. An exacerbating fiscal deficit in the USA with inflationary consequences.
Victor, it's been an absolute pleasure. Thank you very much indeed for joining us today. A lot to digest there. Thank you.
Thank you, Sarah.